Welcome to Small Biz Life, episode 103, LLCs and S Corps.
Does this sound familiar?
Oh my God, I have so much to do today.
Don't forget to breathe.
But I have almost 400 emails in my inbox and 30 phone calls to make.
Have you looked into getting a virtual assistant yet?
Oh, and I need to schedule all my social media posts.
Did you drink anything today?
I had coffee.
Did you eat today?
Did I mention coffee's a bean?
This is Small Biz Life.
Hey guys, welcome to another exciting episode, and I'm sure this is going to be a very exciting episode of Small Biz Life.
That headline is just going to go viral.
Hey, but you know, this is something that I get asked about a lot, so we thought we'd do an episode on it.
So, like, how do I form my company?
Exactly. So, my name's Kristin Ingram.
And I'm Jeffrey W. Ingram.
We are a husband and wife team of small business owners. I'm a CPA.
And I am a IT phenom.
Okay, that's evolving.
Yeah, I still don't know what to call myself.
I thought you were like the VP of BS or something.
I'm the Chief Business Systems Officer, the CBSO.
See, that's a lot of letters.
CBSO.
Okay, that's cool. That works. So we are the owners of Ingram Digital Media, which creates this podcast as well as a couple other websites. And, you know, we've been in business. I think you started your first business 12 years ago.
Sure.
Yeah. And I started my first business 10 years ago. Mm-hmm. And then we formed this business together this year. Mm-hmm. And, you know, we have a passion for helping small business owners and helping to educate all of you out there that are listening to the show. So, you know, some of the topics are much more exciting than others. You know, we like to cover the life side of business. We like to cover the technical, you know, side of business. And then sometimes we got to cover stuff like taxes.
Yeah.
And it's because, you know, I think this is something I get a lot of questions about. I get tagged in a lot of posts about.
Now, would you say this is the most common question that you get pulled in to answer? Yeah,
I think that this is probably, especially for people when they're first starting their businesses, or even maybe you've been in business for a while and you're starting to think like, maybe I should formalize this a little bit more.
And I think the good thing is too, is I do know that there has been some people who you've come across in your small business days where they haven't thought about this and they've made rash decisions here and they've paid huge consequences, literally paid.
Yeah. Paid lots of extra money in taxes, or, you know, maybe they set something up, but they didn't know how it was supposed to work. So we're going to kind of talk today about LLCs from a tax perspective. I'm not an attorney, so we're not going to talk about the legal side. If you want to know about the legal side, go talk to an attorney. I'm going to tell you how it works from a tax perspective. And then we're going to talk about LLC. We're going to talk about S corporations, what they are, how they work, just kind of give you guys an overview so that you know what to look for. Yeah. Because I think, you know, one of the questions I get a lot is like, should I be an S Corp, or when should I become an S Corp? And so I'll kind of tell you my opinion on that. You know, and then if you want to talk to other professionals and get their opinion, but I'll tell you what I do. Yeah.
You know, I think this is a good starting place, but I'm a big believer that these are the types of questions you deal with a professional who understands your numbers. You know, your CPA, an attorney you work with, because especially like legalistically, an LLC can vary pretty dramatically from state to state, what that exactly means, what that exactly covers.
Especially from a legal perspective.
Yes.
From a tax perspective,
really the same.
It's the same. You know, so that's the thing, is like, you've really got to look to
it's
see.
Almost like a non-entity, you might say.
Yes, actually. It's disregarded, actually.
Okay.
But we're going to, you know, let's jump into that. So, an LLC is a limited liability company. Okay. And I think a lot of people think that C stands for corporation. It doesn't. It stands for company. Becoming an LLC does not make you a corporation. Okay. I think that's a big, misconception that people have. So, an LLC is something that you form at the state level. You would have to file with your Secretary of State. Okay. And that's paperwork that, you know, either you can do or an attorney can do for you. Typically, an accountant can't do that for you because that's considered practicing law. And so we're not allowed to do that. But the forms usually are pretty easy.
Yeah.
Okay. So what does it mean when you become an LLC? Well, for a tax perspective, it means absolutely nothing.
Right off the bat, let's just hit that up. That has nothing to do, that will have no financial implications from a tax perspective.
Right. So an LLC is considered a disregarded entity by the IRS. Now, typically when you form an LLC, you're going to go get an employer identification number because you've started this business, right? And, you know, if you listen to the show before, I've said a number of times you want to get an employer identification number no matter what you do.
Yeah, and from an IT side, you know, with the amount of data breaches that happen every year, the less places you can have your social security number, the less businesses you have to give them to, the less times you have to hand that out. You know, it's a way to protect your data as well as, you know, even if you never plan to grow your business, it's a great way to help protect your personal data. So your name is a little bit harder to steal your name.
Right. And, you know, if you're using a service like LegalZoom or Rocket Lawyer or another one of those sites, they're going to try to get you to bundle in your EIN with the rest of the package. You can go to the IRS website. You can get your EIN for free.
In about
5 minutes.
2 minutes?
Yeah.
Well, 5 minutes. I mean, if you've never been there before, 5 minutes.
Yeah. It's a really easy process. It's a super simple form to fill out. And you'll get your EIN right away. So, which a lot of these services, you kind of have to wait for them to electronically process it and email it back to you. If you're in a hurry to try to get everything done, you can just do it yourself. And it's free, which is nice. We like that.
Awesome.
So, the tricky thing for a lot of people when they are filling out the form for the EIN, the only tricky part is determining the type of entity that you have.
Yes.
Okay, so your options, if you're an LLC, by default, if you have one owner, then you're a sole proprietorship. If you currently have a business, you're probably running as a sole proprietorship. You file a Schedule C on your individual tax return, and that's what most people, when they first start out, that's what they are. They're a sole proprietorship as an LLC. If you have more than one owner, then by default you're a partnership. Okay, and you'll file a partnership tax return every year, and then the income from that will go on to each of the partners' individual tax returns.
You need a little bit more paperwork to do that too, because you need like the Articles of Confederation for your partnership or whatever it's called.
You need to have a partnership agreement in most states, which is something that, you know, I would highly recommend that you have that if you have partners. And again, I'm not an attorney.
Define who makes what decisions, who's paying, how the money gets distributed.
Yep, exactly. And that's what that document will do for you. So, you know, you're going to want to talk to an attorney, or you can use one of the online systems if you kind of know. I mean, Jeff and I used an online system when we started Ingram Digital Media, but we're husband and wife, right? And you know,
I've made $1 in years.
Yeah, so you get paid. I just take it. That's all. And I've worked with attorneys before, and I've read a lot of operating agreements before, so I kind of knew what we wanted to have in there. You know, if you're completely unfamiliar with this, I'd highly recommend that you go talk to a small business attorney.
It's not going to cost you a lot of money.
Yeah, it'll probably cost me $400 or $500 to get this done. But especially like if you're working with a friend or you're working with a colleague or somebody that, you know, I mean, even if it's
always
like a
protect
sibling,
yourself, always have it in writing.
Right. You want to make sure that you have an agreement. What happens if somebody dies? What happens if somebody, what happens if somebody becomes addicted to something and needs to go into treatment? What happens? What happens if somebody gets divorced? It handles all of those major life items that you hope never happens while you're in business, but it helps protect the partners that are in there. And then your third option is to become an S corporation. And you have to file another form for that. That is Form 2553. Okay. And we'll kind of talk about the differences between, we're going to mostly focus on sole proprietorships versus S Corps, because most of the S Corps that I work with are single owner S corporations. Okay. And so the easiest way to kind of talk about those two is to talk about single member LLCs treated as sole proprietorship versus an S Corp.
Now, I'm a bit confused on what really is the difference, like just between a partnership and a S Corp, because you have multiple owners. Usually, but not always. I understand that, but what's the big difference?
Okay, so the difference between an S Corp and the other two is the way people get paid. Because if you are an owner of a sole proprietorship or a partnership, you cannot get W-2 wages. It's not allowed.
How the heck do you get money?
So what you do is you take distributions, you take draws. Okay. And, I think it's really important that if you're, if you don't know anything about taxes, it's important to realize that with a sole proprietorship or a partnership, you are taxed based on the profit of the business. You are not taxed based on what you take out of the business. So let's just say, and remember, profit is revenue minus expenses. Okay. So let's say that your profit is $100,000 and you pull out $50,000. How much are you going to pay taxes on? You're going to pay taxes on 100. Okay. It's based off your profit, not based off your draws. And I think that's something I think a lot of people have trouble with. And I know, people who listen to Dave Ramsey, people who listen to, some other financial people, they always say, okay, whatever you draw out of the company, put X% in savings for your taxes and take the rest home. The problem is that
you don't take the draws.
If you don't take all the draws, then you're going to be short on your taxes. So you've got to look at your profit, not just, not what you're pulling out. Because if you just look at what you're pulling out, you're probably not going to pay enough.
So your bigger suggestion would be, like, once a quarter or once a month, look at your profit for that month, take a quarter out and just put it over and forget about the actual withholding. You can take more out if you want to, but take at least that much out, put it somewhere to where you can save it up.
Yeah. And the thing is, with a sole proprietorship or a partnership, you're probably going to be making estimated tax payments every quarter. And just to remind you, estimated tax payments are due April 15th, June 15th, September 15th, and January 15th.
And if you're not making enough money.
Right. When I work with clients, especially if they're beyond their first year in business full time, we will set their estimates equal to last year's tax. As long as you pay in that much, you won't be penalized. And I'll tell you right now, you don't want to pay penalties, but the penalties right now are ridiculously low.
Oh, so you don't really have to recalculate it. You're just kind of going off of last year when you do that.
Right.
Okay.
And so, but the thing you've got to do as a business owner is you've got to say, okay, I know my business is growing. I need to put more money away.
And that's so you don't have to pay the big check.
Well, no, like
the end of the year.
You can make that big check at the end of the year, but you have to make sure you have enough money to do that, plus make your first estimate by April 15th. Okay. So that's kind of, that's the one trap with that system. And most of my clients are disciplined enough that they can do that, or they're making enough profit that they can do that. But, you've got to look to say, okay, April 15th, I'm going to have to, I may have to write a big check for last year, plus make my first estimate for this year. And that first estimate is going to be based off of last year's taxes. So if last year's taxes went up a lot, those estimated tax payments are going to go up a lot. Okay. So you do that for both sole proprietorships and for partnerships. Okay. Now, with an S corporation, you have to pay yourself payroll. If you are working in the business, you have to pay yourself a reasonable salary.
Like $100?
That's not a reasonable salary. No. What I tell people to do is I tell people to, look on a site like salary.com. And then if you're managing the business, you're going to want to add some type of surcharge on top of that for the management portion.
So I do IT work. I would look up the rough equivalent to the job description of the line work I do. And then I would say add 6% or something like that. And
probably more like 10 to 15% for management. The thing that you're trying to think about is if you were going to replace you in the business,
how much would it cost?
How much would it cost you? That's really what we're trying to do. That's what a reasonable salary would be. So if you say, okay, my salary is 22 cents, could we hire someone to replace Jeff for 22 cents?
That is my budget.
I know that's your budget, but we probably couldn't replace you for 22 cents. Okay. Especially for all the stuff that you do.
If someone does actually want to work for us for 22 cents, let me know.
We're going to start getting resumes. Watch. Be careful.
Flood right in.
There you go. But so that's really what you're trying to do. And so people might go, all right, well, what's the difference between the two? So if you receive W-2 wages, you're having federal income tax withheld. You're having Social Security and Medicare tax withheld. The business is going to match your Social Security and Medicare tax. So the way it works is you have 7.65% taken out of your pay. And if you didn't know that, that's the Social Security and Medicare tax rate.
Ugh.
Yeah, I know it's a lot. And then the company matches that. So they pay in another 7.65%.
So before I get a dime, I've lost 15% as well. A little bit over 15%.
Yeah. Mm-hmm. Between what you have withheld and what the company has withheld. Now, you might say, well, wow, that's a lot. But if you're a sole proprietorship, you're paying that 15.3% as well. It's called self-employment tax. So you're still paying that. And actually, if you're a sole proprietorship, you're paying that on all of your profit. Because remember, he said you're taxed on your profit. The reason that S corporations are very popular, especially when you get to that point where your profit is more than that, reasonable salary, anything you make above your wages, and this is why, with S Corp's reasonable compensation is such an issue, anything you make above your W-2 wages and profit is not subject to self-employment tax.
Okay. So just to see if I understand this correctly, essentially what you're saying is if I'm running a retail store and I'm working as a cashier in my retail store, and then I do the manager stuff in the top end, when I get about, let's say, 20% over what a cashier would make, I would then, that's when, for that style of business, I would want to move to S corporation. But if I was a marketer making a lot of money, like where it's a couple $100,000 a year, let's say for a job, it would be like 10 or 20% past. Well,
I don't think it would be like, I wouldn't use a cashier because cashiers make like $10 an hour. Mm-hmm. I would look to see like how much does a retail store manager make? Okay. And then I might add another 5 to 10% on top of that. Okay. Because you're also doing some stuff that like maybe a regional manager would also do. Okay. Right? So let's go back to our $100,000 example. So let's say that you have $100,000 that the company made before you pay yourself anything. Mm-hmm. Okay. If you had a sole proprietorship, you would pay $15,300 in self-employment tax. Okay.
That's a lot of money.
That's a lot of money. Now, let's say instead that you had an S Corp that had $100,000, okay, and you paid yourself $50,000 in salary. When you pay yourself that $50,000 in salary, you're going to pay the 15.3% on that. So that would be...
You're playing the employer part and your part still.
Yep. So that would be $7,650 in taxes. Okay. So that means that just by having the S Corp, you're saving $7,650 in Social Security and Medicare tax. Okay. Because instead of paying the 15.3% on the entire $100,000 like you would with a sole proprietorship, you're only paying it on the amount you take in W-2 wages.
So my question is, like, a lot of corporations I know take a portion of their profits and just reinvest it in their business. Mm-hmm. When you're not a corporation, you have to pay taxes on that money. You can't just save it.
Well, even if you're those large corporations, they're still paying taxes because it's profit, right? So you can do whatever you want with your profit. You can leave it in the company for growth for next year, or you can pull it out. So, but you're still going to pay taxes on it no matter what. Okay. There's no like tax-free reinvestment fund that you can put the money into.
Should be.
Yeah, it doesn't work that way. I mean, it sucks, but it doesn't work that way.
I guess leaving it trapped overseas is what you do.
Yes, exactly. Okay. That's what Apple does. That's why Apple has, $1 trillion or $2 trillion overseas.
Overseas in cash.
Mm-hmm. Okay. It's not all cash. It's a lot of investments and things too.
Well, they call it cash.
Yeah. We actually looked at that in one of my classes last semester because we were like, do they really have that much cash? And so we pulled it up and we looked. And we found out that they have a lot of short and long-term investments that they can sell whenever they want. And analysts consider that cash. Completely off topic. So you can see that, and remember, it has to be reasonable compensation, but maybe for you, reasonable compensation is, let's say that it's $70,000. You're still, in this scenario, you're going to save 15.3% on the $30,000 in profit that is going to flow through. Now, so you might be thinking like, well, hey, this sounds great. Like, let's do this. So there's a couple other things, with S Corps, they've got to understand like some additional costs that you're going to have. So one of the things is that because you have payroll, you're probably going to need a payroll service. The payroll service that most of my clients use is Gusto. It is $39 a month plus $6 per employee. So if you're if you're an S Corp with one employee, it's $45 a month. What this does for you is it calculates the payroll tax, it handles direct deposit, and makes all your tax payments for you. It files all of your quarterly filings, and it does your annual W-2s. Okay. Now, I'll tell you that if you don't have a service like this, your other option is to, you can hire like a bookkeeper to do it, and typically a bookkeeper is going to get some sort of service. You're probably going to pay a bookkeeper more. You can get something like, like QuickBooks Basic Payroll, which just calculates the checks for you. But then you've got to make all the tax deposits. You've got to do the quarterly filings. You've got to do the W-2s, which if you hire an accountant to do that, it's probably going to cost you about $1,000 a year plus the cost of the QuickBooks calculation service. So, there are additional costs just for running the payroll. Okay. Then you also are going to be subject to unemployment tax. I'll tell you in Connecticut, the top tax, well, if you're a new employer, let's do that. A new employer, it's 3.9% on the first 15,000 of wages. And state and federal unemployment is about $42 per employee per year if they make $7,000 or more. Okay. So it's not a tremendous amount of money for unemployment, but it's still an additional cost.
Okay.
The other thing that you've got to look at for an S Corp, is that you have to file a corporate tax return, which means that's additional cost with your accountant. Depending on who your accountant is, you could be looking at, $1,000 to $2,000 more to file that tax return. So, you are looking at additional costs in order to run this. But, if you're looking at, if you're in that $100,000 range, right, and $50,000 in salary, it's definitely, it's not going to cost you another, it's not going to cost you another $7,600, to be an S Corp. It might cost you maybe $2,000, but if you're saving $7,600 in taxes, that might be okay.
Now I can see that where this might make a lot of sense too if you don't have the discipline to make those kind of payments yourself as well, to where it's automatically happening.
Right. And that's the other reason that I recommend S Corps. If you're the type of person that you're not good at managing money, which I hope that you would want to become the type of person who's good at managing money.
At least get better.
At least get better. But, if you say, I don't want to deal with estimated tax payments, I would rather just get a regular salary and I know all the taxes are taken care of. You can become an S Corp sooner. Just realize that it's going to cost you more money to be an S Corp, due to the payroll and the extra tax filing and, the unemployment tax. But, if you're really that kind of person that you're like, I don't want to make estimated tax payments. I don't want to deal with it. I want to get a check every 2 weeks and know the taxes are taken care of, then that might be an option for you. And you might become an S Corp sooner.
Okay.
I know like with, we run 2 businesses, I work for the university. We're really busy people.
It might be worth it for time to save time.
Right. And we're about to become parents. So, I said, when and I didn't even know we were going to be parents at the time that we formed the S Corp. But when we formed Ingram Digital Media, I just said, let's be an S Corp right off the bat. We'll do payroll right away.
At the end of it, not the LLC.
Right now, and I think you make a really good point. So when we started Ingram Digital Media, we knew it was going to be an S Corp from the beginning. And we decided, like, you know what? Let's let the world know that we're incorporated. Because one of the issues with LLCs is because an LLC can be a sole proprietorship, a partnership, or an S corporation, you're going to get a lot of requests if you're an LLC for W-9s. And a W-9 is a form that subcontractors fill out. So if you're doing B2B services, if you're a graphic designer, if you're an attorney, you're an accountant.
For another business, it's business to business, even if you know them as a person.
Right. This is the form that gives people the information to send you a 1099.
Which they're going to be required to if you get over $600 from them.
If you're a sole proprietorship or a partnership. If you're an S corporation and you check off that box, they don't have to send you a 1099.
Oh, okay.
But, you know, if you're an LLC, people don't know what you are. And so they're required to get that form from you.
Okay.
Whereas we figured, hey, you know what? We're just going to say we're incorporated, and that will get rid of some of those requests.
So
now we still get them.
And we still send out the W-9.
Yep. We still send out the W-9 a lot of times with our contracts or with our first bill, just so that people know that we're, you know, they're clear that we're an S Corp. But, you know, having ink at the end of your name on everything can help decrease those requests. So, you know, just so you know, an LLC can cause some confusion in your entity type and people won't know how you're filing.
Yes. For other companies or sometimes for the owners.
But you can also, but if you want, you can form an LLC, which sometimes LLCs are cheaper depending on your state. You can file an LLC and make it an S Corp right away. It just depends on what the fee structure looks like in your state.
Now, I'm just wondering if from a tax purpose, because, you know, you always hear about like incorporating, like all these big companies incorporate in Delaware or, you know, someplace with lower taxes. You know, from a tax perspective, is there really like a huge benefit to switching states?
Okay, so typically people incorporate in Delaware because Delaware's a business-friendly state for lawsuit purposes. So that's actually a legal purpose that people file. Now, if you, from a tax perspective, if you incorporate in one state and you live in another state, you're subject to tax in both of those states. Because you have presence in both of those states.
Oh.
You also have to collect sales tax on sales in both of those states.
Depending on the sales tax laws of the state.
If you have physical presence, which being incorporated in a state gives you physical presence.
Do any states not have sales tax?
There are 5 that don't have sales tax. I know New Hampshire's one of them because we live close to New Hampshire. But yeah, there are only 5. And so... yeah, I think you're thinking of the Amazon tax laws where if you have affiliates in a state, it counts as presence. Being incorporated in a state gives you physical presence in a state.
Oh, okay.
So if
you're
live
definitely done.
Yeah, if you live in one state and you incorporate in a different state, you are subject to sales tax in both of those states.
Oh.
You are subject to income tax in both of those states. And there's 3 tests for that they use to it's called apportionment. To apportion your revenue between the 2 states. They look at how much equipment you have in each of those states. They look at how much in wages you pay in each of those states. And they look at how much in sales you have in those states.
Okay.
So, you know, you may not end up paying any income tax. You know, let's say that you live in Connecticut and you're incorporated in Delaware. Okay. If you don't have any sales in Delaware, you don't have any equipment in Delaware, you don't have any employees in Delaware, then your revenue in Delaware would be 0. But if you have sales where you ship things to Delaware or you have customers in Delaware, all of that revenue is considered Delaware revenue.
Oh.
So you have to be really careful. You know, I was talking to somebody the other day, and they were using Fulfilled by Amazon in order to sell their product.
Yeah, I can see why that would make sense.
All right, so you ship the product to Amazon. Amazon sends it out for you. Lots of companies use this service. If you use Fulfilled by Amazon, you have presence in every single state that Amazon has presence in because you don't know where your inventory is.
Oh.
So.
Because they could put it into their distribution centers.
Mm-hmm. Yeah. So, it's interesting because I tell small business owners this all the time. Tax law was written, in the 19th and 20th century. It has not caught up, to the fact that online business is doing business all over the world. And, people are digital nomads and they don't have a place of residence anymore, right? They're just traveling all over the country. And unfortunately, especially like with the digital nomads, the only real tax law that we have that's kind of settled is we look at sports stars, people like basketball players and football players, and how are they treated for tax purposes. Let's say that, we'll say Tom Brady, because he's my favorite. Let's say that Tom Brady goes and plays a game in Seattle. Well, he would be subject to the tax laws in Washington for that game. And so if I think Seattle has a local income tax now, he would have to pay for the money he made to play that game. He would have to pay taxes in Seattle. If he plays in New York, he has to pay New York taxes on that income. Every time he works in another state, he has to, a portion of his income gets taxed in that state.
Oof.
And, think about for basketball players.
That's a lot of money.
That's a lot of money. I remember that there was a famous story about Peyton Manning that because of the way that his income was apportioned between the states, and some states it's really funky. Like New York's calculation is rigged so that New York gets a hell of a lot more money from you than they should. But he actually paid state income tax on about 140% of his income.
Yeah.
Because some states double counted his income the way that they did their apportionment. And,
Well, I think too, the thing for people to remember is the tax laws are old and they're not written with the ability to sell the way they are. But the states and towns and counties largely are having money problems. They're not going to do anything that they think is going to cost them revenue at this point. If anything, they're going to go the other direction.
And that's the thing is, like, I think a lot of businesses, especially online businesses, they think in terms of federal tax. They don't think in terms of state tax. And state tax is the one that's probably going to bite you, if you have issues. So you really have to think, when you're setting up your business, you've got to be thinking, in addition to the legal stuff, right, and protecting yourself legally, but it's this really popular thing now that I'm going to incorporate in Texas because Texas has no income tax. Okay, well, Texas has sales tax though. And do you have the systems in place to charge, let's say, you incorporate in Connecticut, or I'm sorry, you live in Connecticut, but you incorporate in Texas. Do you have the systems in place to charge Connecticut sales tax and Texas sales tax? Do you have the systems for that? Because if not,
yeah.
Especially if you're an online business, most shopping carts, WooCommerce cannot deal with this. Kajabi does not deal with this. In a state like Connecticut, like digital downloads are taxable.
Yeah.
So if you have presence in Connecticut, how are you going to collect that tax? Or are you just going to eat it? There's a lot of state issues that you have to deal with that. When I get on the phone with people, they're amazed on how state tax works.
And sometimes, I know just from listening to you talk to people, it gets down to the street you're on in towns.
Yeah, I know there's, I did some research on Missouri, and Missouri's like sales tax is based on location. And let's say that you're in St. Louis. If you are across the street from the convention center in St. Louis, it's one tax rate. If you're on the sidewalk outside the convention center, that's a different tax rate. And if you're inside the convention center, it's a third tax rate.
And now too, and I don't know if Missouri has an Amazon law, but if they do, in theory, I don't know that the states could enforce this, but like if someone's in one of those spots and they digitally make a purchase through an affiliate of yours in that state, or it could get really screwy. I don't know if they can possibly enforce that kind of stuff. But
well, I think what a lot of states do for out-of-state businesses, I know what I think it's Tennessee. Tennessee says you just have to collect the state tax rate. You don't have to collect the local tax rate. Okay. Now, in some place like California, it's literally based on where you ship the product in California.
So if you ship it to LA, it could be different than if you ship it to San Diego.
Mm-hmm. Yeah, and they all have local sales tax rates on top of the state. And I know Tennessee does as well. Mm-hmm. But some states have tried to make it a little bit easier for out-of-state people. But like California has not, and that's where there are some, there are systems that you can get that will help you with sales tax, but they're expensive.
Yeah.
So you've got to be really careful. And it doesn't matter whether they're a sole proprietorship, a partnership, an S Corp, a C Corp, you all have to deal with the state issue.
Okay.
So that's why there are actually accountants who specialize in sales tax.
All right.
Because it's such a complicated thing. So, I hope that listening to this episode, you have a little bit more clarity on LLCs and S corporations. If you still have questions about this, we'd love to have you, post them in the Small Biz Life community at facebook.com/group/smallbizlife.
Yeah, because this is one of those two where it's really a very individual type of, you just can't make assumptions.
Right.
This whole conversation gives you a starting point.
Mm-hmm. Yeah, no, and if this is something too that you're still, you have some trouble on, or maybe you want to sit down with somebody, you think that you might have one of these sales tax issues for multi-state, reach out to me. We can set up an appointment to sit down, and talk about this. I love meeting with people on the phone or Google Hangouts. So however I can help you, I will. All right. So thank you so much. I know this was a technical issue. Go to smallbizlife.com. Go to the show notes for this episode. I'll kind of have a little bit of a summary in there to kind of help clarify things for you.
Very good.
All right. We'll see you next week.
This was Small Biz Life.